Subpart F says that if the foreign corporation is a controlled foreign corporation, or CFC, for 30 consecutive days during the CFC's U.S. tax year, then the U.S. shareholder must include in his, her, or its income two things. The first is the shareholder's pro rata share of the CFC's Subpart F income for the year. The second is the shareholder's portion of the CFC's investment of the CFC's earnings and profits, or E&P, in U.S. property. These inclusions are limited based on E&P, and there is a coordination rule between the two inclusions. We'll cover the investment in U.S. property, or Section 956 portion, when we cover that section. Pro rata share of Subpart F income is determined on the last day of the CFC's U.S. tax year. We'll talk about tax years later. This share is, in effect, the undistributed Subpart F income for the year times the portion of the year that the foreign corporation was a CFC. This all hits the shareholder holding the shares on the last day of the year. The actual rule of Section 951A2 is convoluted, and you should read that paragraph carefully more than once. Here's what the rule says. A U.S. person who owns enough shares to be a U.S. shareholder on the last day of the CFC's year must include an amount as Subpart F income. The Subpart F income is one amount reduced by another amount. The first is the amount that would have been distributed to that shareholder on the last day of the year if the CFC had distributed pro rata to all shareholders the total Subpart F income for the year times the portion of the year that it was a CFC. This amount is reduced by distributions to other shareholders as dividends. The reduction is limited to the total Subpart F income times the portion of the year the U.S. shareholder did not own the stock. There's a slight ambiguity in the law, which is clarified in the regulations through examples. Here's an example. AG, a foreign corporation, was a CFC for 183 days and had $2 million of Subpart F net income for the full year and $3 million of other income for the full year. Rolf, not a U.S. person, owned 60% of AG and sold it to Fred on July 2nd. Gustav, not a U.S. person, owned 40% of AG throughout the year, and Gustav got a dividend of $1.5 million during the year. Fred, the U.S. person, owned 60% of the shares for 92 days, but none at year end. He sold the shares to Joe, a U.S. person, who held 60% of the shares for the last 91 days of the year. Subpart F is irrelevant to Rolf and Gustav, as they are not U.S. persons. Fred has no Subpart F inclusion because he owned no shares at year end. Joe has a Subpart F inclusion and must calculate it as follows. The Subpart F income is limited to half of the otherwise Subpart F income for the year, since AG was a CFC for only half the year. Joe thus potentially has a $1 million inclusion. This is reduced, however, by part of the dividend to Gustav. That part is limited to the dividend Gustav would have received if the dividend had been only the total Subpart F income times the portion of the year Gustav held the shares. Since he owned 40% of the shares all year, the reduction is 40% of the $2 million Subpart F income, or $800,000. Thus, Joe has a Subpart F inclusion of $200,000. This aspect of the limitation on inclusions can be helpful or harmful to a particular shareholder. The examples in the regulations provide more variations, and I encourage you to read them. Keep in mind that Subpart F does not cause income. It merely causes lack of deferral of the income. Subpart F income of a CFC includes only certain types of income, as shown here. This sort of income is inherently portable. That is, it can be put anywhere a group of companies wants it to be without the group changing its operations. Foreign-based company income includes 4 types of income, as shown here. This video will cover foreign personal holding company income. Foreign-based company sales income and foreign-based company services income will be covered in a separate webinar and possibly video. We won't cover oil-related income. We talked about FPHC, or Foreign Personal Holding Company, income before in the coverage of the passive basket rules. Those passive basket definitions are in Subpart F. We'll cover them in depth now. The key types of FPHC income are dividends, interest, rents, royalties, and annuities, plus gains on assets producing this kind of income. Moving this kind of income to another entity is easy. You just transfer ownership of the assets producing it. The idea of Subpart F was not to prevent such transfer, but to prevent tax deferral as a result of it. Before we proceed with FPHC income, I want to mention a key exception and give my only editorial. This exception has no sound tax policy behind it. It was a giveaway to large multinationals. Section 954C6 accepts from Subpart F income almost all FPHC income received from related foreign parties, thus effectively gutting a key part of Subpart F. The provision was originally scheduled to expire in 2009. It has been renewed 4 times, 3 of which were retroactive. It has currently expired, but if enough congressmen are bribed, I'm sure it will be renewed retroactively again. The provision is simple. Dividends, interest, rents, and royalties from related foreign parties are not Subpart F income unless attributable to or allocable to Subpart F income of the payor. This has implications for determining the basket of income as well as Subpart F inclusions. So let's proceed with the assumption that the now dead Section 954C6 stays dead. U.S. shareholders of a CFC must include in their income their shares of net Subpart F income. The steps to determining this are as follows. First, determine if Subpart F income is Subpart F gross income. Next, apply the exceptions to FPHC income or FBC income. Finally, allocate and apportion deductions to items of income that are Subpart F income after applying those exceptions. The item of income rules for passive Subpart F income are the same rules as used for determining the high tax exception for basketizing income for the foreign tax credit. These are covered in a separate video linked here. For non-passive income, an item includes all income within a single category of FPHC income or a single category of foreign-based company income. The categories are those things listed as lettered items in the 2 definitions in the law. Thus, all non-passive or look-through dividends, interest, rents, royalties, and annuities are a single item, and all gains on property transactions other than commodities are a single item. The regulations explicitly state that losses within one category or item of income do not reduce other categories or items except through the earnings and profits limitation. That and other limits on Subpart F inclusions will be discussed in another video. There are several other exceptions to FPHC income that are based on sound tax policy. The coverage in this video will deviate from the order in the law for the sake of simplicity. Rents and royalties are excluded from Subpart F and from the definition of passive income if they are from unrelated parties and received as part of an active business of renting, leasing, or licensing property. This is a fact-based test. For the test to apply, the assets rented or licensed must meet one of three alternative sets of criteria. These bear no resemblance to the tests under the passive activity loss limitations. They are unique to Subpart F and the definition of passive income. The business is an active renting or licensing business if the assets rented were made by the CFC, or if the assets licensed were developed by the CFC. The CFC may have received help in making or developing, but it must be regularly engaged in such making or developing. For example, a CFC that manufactures machines is in an active business, and rents received from unrelated customers for use of those machines that the CFC made is not Subpart F income. Similarly, if a CFC regularly develops software and licenses it to unrelated parties, the royalties from such licensing are not Subpart F income. This puts rent and royalty income on the CFC's products on the same footing as profits from selling the goods it made or the intangibles it developed. We'll cover the sales income side in our coverage of foreign-based company sales income. A realty rental business is active if the CFC, through its own officers and employees, regularly performs active and substantial management and operational functions while the property is leased. Two examples in the regulations can illustrate this exclusion and its limits. If a CFC owns an apartment complex and contracts out the management and maintenance to another party, then the rents do not qualify for the active rental exclusion. By contrast, if a CFC owns an office building and, using its own staff, does the leasing and maintenance, then the rents are from an active rental business. The business of a CFC in licensing property it did not develop also qualifies as active if the CFC performs substantial marketing functions through its own officers and employees in a foreign country that meet a substantiality test. That test is met if the active licensing expenses exceed 20% of the adjusted licensing profit. The expenses and profit are those of the CFC, computed ignoring rents, shareholder or officer compensation, property taxes, and payments to independent contractors. Thus, if a CFC has a substantial marketing staff and licenses to unrelated parties, and the expenses meet that 25% test, the licensing income is not Subpart F income. FPHC income also excludes interest and dividend income received from a related party in the same country. To qualify for this exclusion, the CFC recipient and related payor must be created or organized in the same country. The payor CFC must also use a substantial part of its assets in a trade or business in that country. If the payor of interest is a partnership, the payment is treated as a payment by a corporate partner to the extent it is allocable under U.S. tax rules on partnerships to that corporate partner. I discussed the related person rules in the previous video. This same country exclusion allows having separate corporations within a country without running afoul of Subpart F. For example, we could have a German holding company with 3 German subsidiaries, where the subsidiaries operate different parts of the business. Payments of interest or dividends by the subsidiaries to the parent or each other would not trigger Subpart F inclusions. There are 2 exceptions to this same country exception. Any dividends must meet 2 tests. The payor CFC must be owned directly or indirectly through a chain of ownership. Each CFC in the chain must meet the same country exception tests. The dividends must also be paid out of E&P earned while the payor was a related person and met the same country tests. Let's look at an example with alternatives. A U.S. person owns a UK subsidiary, which in turn owns another subsidiary. The lower tier sub pays the UK sub a dividend. If the lower tier sub was incorporated in the UK and had a substantial part of its assets used in a UK business, then the same country exception applies. If it was incorporated in Switzerland, then the same country exception does not apply. I'll come back to this example again when I discuss the high tax exception. Under the second exception, interest income is not excluded if the interest expense of the payor is properly allocable under the 861 rules to Subpart F income. A circularity rule applies for ordering determinations for CFCs that are both recipients and payors of interest. The same country exception applies only if the payor has a substantial part of its assets used in a trade or business in that same country. The rules under the reorganization provisions are used with some modifications to determine whether this substantial part of assets test is met. Rents and royalties are excluded from Subpart F under a similar same country rule. FPHC income includes rents and royalties from a related country CFC for that person's use of property in the same country in which the recipient CFC is incorporated. A rule similar to the interest rule applies to a partnership payor of rents and royalties. Such payments are treated as coming from a corporate partner, a requirement for the exclusion, to the extent allocable to that partner. Also, rents and royalties are not excluded to the extent the deduction of the payor is allocable to Subpart F income. And here's a quiz. Gains from the sale of property are Subpart F income in several cases. First, gains from disposition of property that gives rise to Subpart F income are themselves Subpart F income. Thus, if a bond is sold at a gain, the gain is Subpart F income, unless the interest income on the bond would meet one of the exclusions. Second, gains from property that does not give rise to any income is Subpart F income. Thus, gain on sale of unused bare land is also Subpart F income. Third, gains equivalent to interest are treated as interest and potentially characterized as Subpart F income. Fourth, gain on disposition of various entity interests, as shown here, is Subpart F income. However, gain on sale of shares of a subsidiary may be recharacterized as a dividend, as we'll discuss in coverage of Section 1248. If recharacterized, the dividend rules we talked about earlier apply. Commodities gains give rise to Subpart F income for all CFCs other than dealers in those commodities. However, such gains may be from hedging something else and be recharacterized as the something else. Remember the Corn Products Doctrine on treating hedging gain as ordinary income? There are similar rules in the Subpart F regulations on commodities. Net foreign exchange gain may or may not be Subpart F income. Foreign currency gain or loss related to the business needs of the CFC is excluded from FPHC income. Substantial detailed rules and several optional elections apply that are beyond the scope of this course. The excess of other foreign exchange gains over foreign exchange losses is FPHC income. The amount and treatment of such gains is determined under the foreign currency rules that will be discussed in a later module. There are several other issues under the foreign personal holding company income provisions, as shown here. These are all beyond the scope of this course. And here's a quiz. Income is excluded from FPHC income if it meets the high tax exception. We covered a similar high tax exception in foreign tax credit baskets, the high tax kickout, as we called it there. The Subpart F high tax exception works much the same, but at a slightly lower threshold. Items of income are not considered Subpart F income if they are subject to an effective foreign tax rate greater than 90% of the U.S. corporate tax rate. As with the high tax kickout, income and deductions are computed under U.S. and not foreign rules, and the foreign tax paid or accrued is compared to this net income. The present U.S. corporate tax rate is 35%. 90% of that is 31.5%. Thus, if the effective rate of foreign tax exceeds 31.5% for an item of net income, then the item is not Subpart F income. The law says high tax income is excluded. The regulations say you only get to exclude if you make an election to do so. The taxpayer can thus get it either way. Let's go back to the earlier example and consider some more possibilities. A U.S. person owns 100% of a U.K. corporation. The U.K. corporation is a CFC. The U.K. corporation owns 100% of a subsidiary. Assume the sub is organized and doing business in France, paying French tax on its income, and its French income and deductions are the same under U.S. and French principles. The corporate tax rate in France is 33%. Thus, none of the French sub's income is Subpart F income under the high tax exception, regardless of what sort of income it is. The income is also not passive. The passive basket high tax kickout applies the same 90% test for income of CFCs. The UK and France are members of the European Union. EU rules say there is no withholding tax permitted on payments of dividends from one EU country company to another EU country company. A dividend from the French sub would have no withholding tax, but it would carry with it deemed paid credits that we talked about in our coverage of Section 902. So if the French sub pays a dividend to the UK sub, that dividend is not Subpart F income because the dividend carries with it that 33% effective French tax rate. However, if the French sub pays interest to the UK sub, there's no deemed paid tax, and the interest income must be tested at the UK level. The current UK corporate tax rate is about 25%, so the high tax exception won't apply to the UK interest income since there's no deemed paid credit and the only foreign tax is at 25%. As with the basketizing rules, determining the effective foreign tax rate requires more effort than I just mentioned. For details on the process, see the video on Section 902 linked here and the regulations shown here. To sum up, Subpart F income includes foreign personal holding company income as well as other income. Dividends, interest, rents, royalties, annuities, and many types of gains from property transactions are all treated as FPHC income unless an exception applies. The key exceptions are the same country exception, active rents and royalties exception, the currently expired Section 954C6 exception, and the high tax exception.